A new round of mortgage wars has broken out ahead of next week's rates decision by the Reserve Bank. Banks are jostling for new customers, with around 20 lenders cutting their fixed rate loans, and even variable rates are starting to come down. Emily Stewart reports.
Morlick Nike is looking for the best mortgage deal on offer. His home loan is about to roll off its fixed rate after 4 years under 2%.
Coming out of fixed rate and jumping onto the ranges of 6% is uncertain, and it makes you feel nervous.
Repayments on his $470,000 home loan will increase by more than 50%.
I'll speak to my bank directly and see what they offer, and also see what offers are there in the market from other banks through my brokers.
Luckily for Morlick, competition between lenders is heating up ahead of the Reserve Bank's next board meeting. More than 20 have cut their fixed rates in the last month.
We are now seeing fixed rates in the fours. We typically see fixed rates start to come down ahead of an anticipated RBA rate cut. What is interesting at this point in time is that we're also seeing some new customer variable rates start to fall.
Lenders are jostling for market share. The country's biggest bank, CBA, grew its home loan book by more than 4% in the first 3 months of this year. Last week, it cut its variable rate to 5.84% to match Westpac and ANZ.
There are 35 lenders on our database that are offering at least one variable rate under 5.75%. You can actually do better than what the big banks are offering.
The official interest rate is currently sitting at 4.1%, and most economists are forecasting the Reserve Bank will cut interest rates by 1/4 of a percentage point next week, while NAB is predicting a double rate cut.
If you look at the threat from the global trade situation, the downtrend in inflation, weak consumer spending, they point to rate cuts.
A homeowner with a $750,000 mortgage would save more than $100 a month if the RBA reduces interest rates by 1/4 of a percentage point, provided the lender passes it on. Economists think that more rate cuts are on the way.
For the remainder of the year, we're expecting at least another cut in August, possibly another one in November, and then one more early next year in February, ultimately taking the official cash rate down to around 3.1% to 3.35%.
CanStar's Sally Tyndall has run the numbers on whether a fixed or variable rate is cheaper.
We looked at an owner-occupier with a $600,000 debt, looking at the lowest 2-year fixed rate in the market versus the lowest variable rate. If CBA's forecast materialises and there's 3 more cash rate cuts, it is a line ball call over the next 2 years about which option comes out cheaper in terms of fixed and variable.
Food for thought for anyone with a mortgage.
Nearly 90,000 people found a new job in April, the surge in employment taking economists by surprise. The figures show the majority of new roles were full-time positions, mainly filled by women. Despite the mini-jobs boom, markets say there's a 90% chance the RBA will cut rates again. Rihanna Whitton reports.
Support workers provide Gazella with the help she needs to keep living at home.
A little bit for company, do me job what I need, do me shopping.
As the nation ages, our need for aged care workers is helping to fuel a jobs boom.
It's nice to be able to help them and give back.
89,000 people found work in April. The majority of them were women in mainly full-time roles. Yet the unemployment rate remained steady at 4.1%, as more people either found work or decided to look for a job, pushing the participation rate to a near record high.
This shows the resilience of the Australian economy, but also the labour market.
Over the last year or so, we've really seen an increase in health and social assistance employment. We've also seen quite a strong pickup in construction, and that tends to be somewhat publicly funded.
Other types of jobs are harder to come by. Arefe Rad spent 8 months applying for roles in urban planning. widening her search to other fields.
I just need a right position to enter a company and to contribute and to bring my skills and my experience.
Economists say the strong jobs data should not stop the Reserve Bank from delivering a rate cut when its board meets next week, something that would provide welcome relief to borrowers.
The RBA is going to be looking at inflation, they're going to be looking at wages growth, they're going to be looking at what's happening in the private sector with retail, and we really haven't seen anything there that would stop them cutting if they want.
An economy in need of a reprieve.
To the share market, where it was a positive end to the week. The ASX 200 and the All Ords up 1.4% each by Friday's close. Independent economist Evan Lucas joined me to wrap up the trading week. Evan, this week markets both here and in the US have really welcomed the de-escalation in the US-China trade dispute, if you like. But to quote Justin Wolfers, tariffs have a half-life of around 6 days. Are investors getting ahead of themselves?
I think they've been getting ahead of themselves pretty much from, April 8th. I mean, we did see the decline and then this rapid increase as the administration sort of backed away from liberation sort of tariff numbers with all of their changes, taking it off. I mean, again, all that we've got at the moment are pauses. So we have 2 dates now in our diaries in terms of where you're going to look at it, which is mid-July. It's actually about the 13th of July for the first 90-day pause for all countries. And then you've got the 9th of August, which is now the new 90-day pause that we have for China specifically. So it's far from done. And I agree, there's a half-life for this as well, because it could actually be a thought bubble, a tweet, a Truth Social post of some description that changes this all up. I mean, again, let's have a look. A week ago, we were talking about 100% tariffs on all films manufactured outside of the US. So this is far from done. And there's been this argument. It's equity specifically. If you look at bonds, they have not given up the idea that this is far from over, and bond markets particularly are very, very nervous about the future. Equities somehow are looking through this much, much cleaner than I think they should be.
Well, the JP Morgan boss Jamie Dimon told Bloomberg at the end of the week a US recession is still a live risk.
Yeah, and I agree with him. I mean, the other thing that we're seeing in the data is that it's going to be a tale of two stories for this year for the GDP figure. We know from new auto sales in the States that Americans are forward buying orders to try and beat the tariff increase. You saw in the last sort of week that the CFO of Walmart said that the increases from the tariffs on their costs are likely to be put through to consumers in the next couple of weeks themselves. You know from Ford and also from others that forward guidance can't be given. So we've got consumption right now off the back of the fact that they are freaking out that at the end of the year they're going to be paying as much as 25% increase on steel and aluminium products, 10% pretty much on everything else, and then whatever the China export costs will be passed through, whether it's the full 145 that's being bought right now or the new 30% tariff on top of it. Whatever it is, the consumer's going to get hit between the eyeballs, and that brings the recession risk absolutely to the fore, because at the end of the year, US consumers are going to have significantly higher prices and they're going to stop consuming, which means you're going to face a recession risk.
Well, on that point, if we're looking at higher prices for consumers down the track, that runs in contrast to the inflation data that we got out at the end of the week, which was producer prices, which sent the US dollar down, Treasury yields down as traders pulled back their rate cut, or raised rather their rate cut bets.
They did, and this is probably also what supported this week's markets, is that exact idea that maybe the Fed is back in play. They can actually cut rates at their next meeting. Again, though, listening to what they said at their last meeting, which was only a couple of weeks ago, they are very, very aware and very, very cognizant that stagflation, so high inflation and possibility of high unemployment, is a real issue. And therefore, even with this week's data around the producers index, it may not be enough, because again, if you look, the core PCE inflation read is ticking up. It's not ticking down. It's at 3.4. They need it to be at 2. That's a long way away from where it should be. And cutting rates at a slightly higher level of inflation is something they're really, really worried about. So markets, again, are judging on one piece of data. The collective data is that it's still not there yet.
So how overpriced do you think markets are in this environment?
So again, if we look at the US, they hit overbought this week. So it started on Wednesday and it's gone through all the way through to, the 5-day trading close as well. It's already there. So there's already that risk anyway that the market's due a pullback from the low of the April 8th to where we are now. US market's up over 15.5%. So you'd argue they're already there. It's a question then about when does the issues about a possible recession, the earnings growth that is now not longer guided anymore, come to the fore. I think that's going to start really popping up in June as we get towards the understanding that the Chinese have had problems, tariffs have slowed people down, prices are increasing for no other reason than tariffs. They will be the reasons markets start to pull back.
Evan Lucas, thank you.
Thanks, Alicia.
The US president's chaotic tariffs have sparked a trade war with rivals, friends and allies. At the centre of the US trade policy, an attempt to even out the US current account deficit, which currently sits at $304 billion US dollars. But according to Steve Keen, honorary professor at University College London, Donald Trump's attempts to right the trade imbalance is more likely to result in a US recession. Steve Keen, welcome to Close of Business.
Nice to be here. Long time since I've been in the ABC building.
Donald Trump has recently said trade deficits are no longer an economic problem, but a national emergency that threatens the US way of life. Sounds like protectionism. What's he protecting?
Well, what he's protecting is because you're running a trade deficit, money created domestically by the government and by the private financial system actually ends up by a complicated chain of transactions, increasing the money supply of the country you're importing from. So China gets a greater rate of growth of the money supply, and they've turned that into a massive rate of investment, whereas America has fallen completely behind. So when you look at the rate of per capita economic growth in China over the last 40 years, it's about 8% per annum, which means China's per capita wealth doubles every 7 or 8 years. America's 1.7%, it takes 40 years to double. So China's winning out of running a trade surplus and America's losing.
If the US is able to achieve its objective of devaluing the US dollar and reversing its trade position in this electoral cycle, what does it look like? It doesn't have a huge amount to export.
Well, it still has a substantial manufacturing sector, of course. And a lot of innovation occurs in America these days, which used to take place in Japan before their bubble economy burst. So they still have a base to work from. But the big trouble they have is they've got to not just bring the manufacturing back on shore, they have to also train the skilled workers they need for machine tools and things of that nature. And there's a famous clip you can find on the internet where Tim Cook, the head of Apple, said that if he wanted to have all the machine tool experts in America in one room, he could fit it inside the auditorium he was speaking in, whereas in China he'd need to rent a couple of dozen football stadiums. So China's upskilled and America has downskilled. That's the major problem they face. Also, of course, if manufacturing comes back, it's going to have a lot less labour than it had when it went offshore in the 80s and 90s.
Many conventional economists don't believe that trade deficits hurt the economy and can be beneficial to living standards by essentially just exchanging paper money for goods that make our lives better. Do they have it wrong?
Yeah, that's pretty dumb. It's thinking statically about a dynamic issue. Yes, okay, if you send over pieces of paper that don't cost you much to make, and you look at the cost of production of money, it's far less than the value of money. Of course, it takes a lot of time to make a manufactured good and a lot of inputs and so on. So yes, out of each individual trade you gain. But what then happens is you stop investing, you stop developing the technology, the country that's doing the exporting and the manufacturing builds up its industrial prowess, and you end up being stripped of your productive capabilities. So I think it's a simple argument for simple minds.
Donald Trump is very enthusiastic about the use of tariffs. Will they work?
Well, that's the problem. They've got a good idea of getting rid of trade imbalances and a bad mechanism, because you could have used tariffs in the 19th century, and in fact America did that. But ever since the 1970s, American corporations largely have relocated their productive facilities overseas to take advantage of cheap wages, and as a result of that, about 40% of global trade passes within the same company. It's between countries, but in the same company. And they also ship components willy-nilly between different countries. You can find examples of components that go through 5 countries on the way to and from America. Now, that means they're going to be facing the tariff 5 times inside the same company. It's going to screw the accounts of corporations. It's not the way to bring back, you certainly can't maintain the production, and it's going to be causing chaos in American boardrooms.
If the US continues down this path with tariffs, even against its friends, what's it going to achieve? What's the end game here for the US?
Well, I think the main thing I worry about is the obsession with running a balanced budget, the government budget. That's, I think, a big mistake. But the combination of the two are likely to mean America goes into a recession.
You mentioned a US recession. How bad could it be?
Not as bad as the global financial crisis, which, of course, again, mainstream economists did not see coming. Their models don't include the role of money or debt or credit in macroeconomics, so they didn't see that coming. This could be a different form of shock, but I've already heard that there's about a 3-fold increase in container bookings from China to America after the most recent decline. So it could be a very short, sharp punch, a bit like a very condensed version of COVID.
Finally, Steve, I think it's important that we delineate your view on Trump's approach versus the US trade policy objectives.
Yeah, well, the trade policy objective, I think, is quite sensible. Unbalanced trade was supposed to be fixed up by exchange rate movements. When you first had people arguing for floating exchange rates back in the 1970s, when the old Bretton Woods fixed exchange rate to the gold was abolished, the argument was, well, you know, just let the market mechanism work and prices will drive us toward equilibrium. Well, 50 years later, equilibrium is equally further away. For example, the country that I now live in, the Netherlands, has been running a consistent trade surplus of 8% of GDP. America has been running a consistent trade deficit of 4% of GDP. None of this has changed over time. So the price mechanism doesn't work the way that economic textbooks think it works. You have to do something different. You have to design a mechanism that makes it unpalatable for countries to run sustained trade deficits or surpluses.
Steve Keen, thank you.
Thank you.
Demand for Chinese-made electric cars drove global sales to a new high last year. 17 million, or 1 in 5 cars sold worldwide, were EVs in 2024, according to the International Energy Agency. China was the engine of this growth, delivering 11 million EVs, or 40% of all sales. The South American and Southeast Asian markets led the charge, but growth in the EU and USA was tepid due to tariffs slapped on Chinese car makers. Bunnings is a household name trusted by many consumers on its promise of low prices alongside a charity snag. But a joint investigation by the ABC's Four Corners program and the business reveals there's a catch on thousands of products when it comes to the retail giant's famous price guarantee. Here's the first of 2 exclusive reports from Amelia Terzon.
Bunnings is Australia's most trusted brand and everybody knows its catchphrase.
Craft Dry Toolbox $11.
Where you find a competitor's lower price on the same stocked item, we'll beat it by 10%.
Now a joint Four Corners and the business investigation can reveal the hardware chain's price pledge isn't always so straightforward as it seems.
So I've just gone shopping at Bunnings and I bought this toolbox by a brand called Craft and this barbecue tool by Jumbuck. Nowhere on the labelling here does it say the word Bunnings, but these are actually home brands, which would make it pretty difficult for you to find this product elsewhere and compare prices.
Shoppers don't always know they're buying it.
Where do you think Jumbuck is from?
I believe that's an Australian brand.
It's actually Bunnings' home brand.
Oh, there you go.
I think that's the way big operators are, is that they give a picture of diversity and range of products when it's not quite true.
Our investigation found that Bunnings owns trademarks attached to 40 brands. After questions, the retailer says it has more than 9,000 own brand products. Everything from Jumbuck barbecues to marquee outdoor furniture, Craft toolboxes, Mondella toilets and Happy Tales pet supplies.
Hi, I'm Adam Doval and welcome to Trojan's Tools for Tasks.
Some home brand lines like Trojan Tools even have their own websites.
We call these phantom brands, and all of that is trying to create
that sense of premium. This is not just kind of a cheap and nasty product. This is a real product or a real brand.
Competition regulator the ACCC says that home brand could become misleading or deceptive if it's marketed as though it's produced by a third party.
There is a bit of a fine line here between marketing and branding and advertising and being deceptive. It can be very hard for consumers to tell the difference.
Bunnings declined an interview but says it complies with all legal and regulatory requirements for product labelling.
Ryobi 18-volt blower kit, $199.
The company, owned by corporate giant Wesfarmers, heavily promotes its famed price match guarantee. In store, our investigation found the pledge slapped onto racks of home brand products across various stores and in dozens of instances. Bunnings rivals say the pledge is a dud.
The 10% beat thing is illusionary because it only applies to a limited number of Bunnings products.
I wish consumers realised that in that instance that 10% price match guarantee means nothing.
Consumer advocacy group Choice would like things made much clearer.
Incorporation of some kind of labelling into the packaging and products would be really useful.
These tools are ideal for tough conditions.
As well as home brand products, Bunnings also has exclusive supply deals with brands like Ryobi.
Bunnings says that it's not using home brand and exclusive products to prevent customers from using its famous lowest prices policy. It says that if you can find a similar item elsewhere for cheaper, it will still beat this by 10%. Would you do that?
Not on cheap products, no. If I'm here at Bunnings, then it's usually because I'm a bit pressed for time.
I think it's largely a marketing line rather than something that gets called out very often.
Bunnings' competitor, Mitre 10, also has a range of private labels, as does Coles, Woolworths, Aldi, and another Wesfarmers chain, Kmart, is now famous for its brand Anko.
It's a lot high margin for them, so they don't need to negotiate with other brands, they control it. The other reason is that it can help fill them out a category. We want to be careful that we're not pushing out all of the other brands, right? I don't want to see a future where we keep pushing everything into private label,
leaving consumers with less choice.
A former chair of the competition watchdog says there's a strong case for an inquiry into the alleged anti-competitive behaviour of hardware giant Bunnings. Speaking on Friday, Treasurer Jim Chalmers says the government's focus has been the probe into supermarkets, but said a beefed-up ACCC has the resources to investigate if required. Here's Amelia Terzon with the second part of the investigation into Bunnings' market power.
Closing up shop has been difficult for Tom Ryan.
We used to have hundreds and hundreds of plants, different types in here.
The nursery was trading at a loss before Tom put it into liquidation.
Especially the last 6 months, there's been really massive stress on me.
Tom blames several factors for the business's failure, including 2 Bunnings stores which operate within a 10-kilometre radius of his nursery.
On the last day that we were going out of business and we were selling everything, I had a lot of customers come in and they say, "We love Y Nursery, we love your staff, we love your coffee shop and the advice that you give, but we go to Bunnings because it's cheaper."
Bunnings' market power is under scrutiny after a joint Four Corners and the Business investigation. In response, the company sent an email to suppliers reaffirming its commitment to them. Former ACCC Chair Professor Alan Fels says the issues raised in the ABC investigation were concerning.
There's a strong case for an inquiry into hardware and especially the role of Bunnings.
Meanwhile, the government says a Senate inquiry into big box retailers like Bunnings will still report by the end of this month. Bunnings, which is owned by Wesfarmers, says that it's operating in a highly competitive market that doesn't just include other DIY stores, but competitors like Coles, Amazon, Petstock and Spotlight, which gives it, it says, a market share of just 17%. But research firm Indepth puts its stake in hardware retail much higher, noting that it's far and away the leading player in the sector.
Every box is much more than just a box.
Bunnings' nearest competitor in hardware is Metcash, which, according to the Indepth figures, holds less than 3% of the hardware retail market. Metcash supplies products to hundreds of stores under the Mitre 10 and Home Hardware banners.
How are you today, man?
David Woodman's family has owned hardware stores since the 1930s. He says that this one is under threat.
Bunnings have bought the property next door and have advertised or put in the newspapers that they're going to build a 15,000 plus square metre box next door to us.
Bunnings says its expansion strategy is all about enhancing competition. But our investigation found that Bunnings is using exclusivity clauses in shopping centre leases that stop rival tool retailers from moving in.
The exclusivity arrangements look to be quite anti-competitive and possibly illegal under the competition law and needing an in-depth investigation by the ACCC.
The supermarket sector agreed to stop using these clauses more than a decade ago after the ACCC said that they stifled competition. Bunnings says that it only uses exclusivity clauses on select occasions and they last at most 10 years.
The fact that it goes for 10 years, that's a long period of time. It entrenches market power.
The ACCC is getting new powers soon that'll give it more oversight over things like creeping acquisitions by major companies, as well as things like land purchases and exclusivity clauses in leases.
Michael Donnell's family has also been in hardware for generations.
Bunnings are the biggest guys out there because there's no other small hardware independents left anymore. You're up against the big boys there and they control everything. In reality, you can see yourself dying because my figures over the last 10 years are just slowly going backwards.
Another small operator that might close its doors.
And that's all from Close of Business. I'm Alicia Barry. Thanks for watching.